Welcome to the Mortgage 101 podcast with Anthony and Manley.
Welcome back to the Mortgage 101 podcast with Anthony and Manley, the show that helps you cut through the noise, understand the process, move forward with confidence in any market. Let's get into it. Welcome back to the Mortgage 101 podcast, where we cut through the noise and bring you real talk on the housing market. I'm Manley, and today we're playing a game, red light, green light. Remember that from your childhood? Well, that's where the market is right now. One signal says go, and the other screams stop. Confusing? You bet. By the end of today's show, you'll know how to move smart, whether you're buying or selling or just watching from the sidelines. Anthony's joining us from Hawaii, probably wishing the Fed would send some of that sunshine over our way for these rates. But Anthony, how's it going out there?
Aloha, Manley. I am doing amazing. You know, I wish we'd be playing Red Rover, tell the feds to make the interest rate lower. But yeah, that ain't happening, man. Although the feds seem to think that the rates still need to be cool and calm. You know, the mantra that they have been touting since the first quarter of 2025 is we want rates higher for longer. And they are not moving from that position. It's not a red light to say stop. It's not a green light to say go. It's a yellow light to say make sure you know the intersections that you're going through are clear and you have an understanding of who has the right of way and who doesn't. So hopefully with this podcast, this episode, people get a firm understanding of that.
Well, that's right. We'll break it down. The housing market's confusing comeback, why higher for longer rates might not be the villain you think, how buyers are stepping up, why investors are backing out, and what's good news for you. And don't miss our rapid fire buzzwords with Kevin, our super producer in the background here. Let's dive right in. Single family home sales are surging, but economic warning lights are flashing red. What gives? Here's what really matters on your next move. A new single family home sales jumped in April, and builders are building fast to meet demand. It looks like the market's heating up again, Anthony.
It is. It's heating up because, I mean, right now, I feel like we've been at a red light and people have been kind of waiting for the feds to make their move, right? People are looking for the clear sign to say it is go time. And they're not going to find that clear sign. It's really up to the consumer to make the decision to say, hey, is it my time to get off the sidelines now? Is it my time to refinance? Is it my time to purchase? And everyone's got a different story, right? Everyone has a different set of circumstances. It really depends on your circumstances, your story. Does it make economic sense? Do not make sure your decisions are based off of fear of the unknown. Make sure that it's based off of sound advice that you're getting from people like myself and you, and you're not on the sidelines due to other people's fear and inaccuracies. I mean, that's what it's all about.
Yeah, we gotta watch the momentum warning signs here, but we also can't get deer in the headlights on that. You've got to dig deeper. You just got to talk to somebody like me and Anthony here that's going to take you deeper in understanding what's going on. This, you know, that's where we're at right now. There's a lot of competition out there. You got to know your numbers, and let's see where this takes us.
Yeah, I mean, here's the twist. The IDEA index, which measures the overall economic conditions, in June, it dropped into the red. All right. That means trouble could be brewing on the surface. You know, that's basically a cautionary sign of, you know, if you think of the F1 racers, and if there's a collision ahead that the other racers can't see, they throw the red, you know, caution flag going, slow down. And that's all the feds are trying to do. The feds are very forward thinking. And you can really understand a lot of what the feds are thinking by what they do, but more importantly, what they don't do, because they are the definition of all bark, no bite. They don't want to be the bite because the bite has repercussions. The bark tries to tailor the economy and the American people to do things. It's almost like try to envision, you know, back in the Wild West days when you had the cattles and you had, you know, them, you know, trying to rear the cattle in. I feel like that's exactly what the feds are trying to do to the American people in the form of spending habits. And they're trying to rear us in going like, hey, we can kind of see ahead that you can't see. And so, try to do this, try to do that. And if the American people don't listen, then that bark gets louder and louder and louder until it's like, oh my God, I'm about to get bit. That's exactly how the feds react. And so I see a lot of, like, over the weekend, so many people were mad. They're like, I can't believe the feds didn't drop the rate. I can't believe they didn't do it. They don't care about the American people. And I feel like it's like the parent telling the kid he can't have gummy worms for dinner. And it's like the kid wants gummy worms and he's like, yo, this tastes good. It makes my belly feel good. And we're mad. We can't have our gummy worms. The same with the American people.
Let's not have a tantrum here. Let's not have a tantrum here.
Yeah, exactly. They want to spend and they want to achieve that American dream. But if the engine is not operating in a way that is beneficial, the feds are going to sound the alarm. And I feel that's when you see the headlines that we're seeing now, they're sounding the alarm. And it's not because they're just waking up and want to sound alarm. They're looking at the metrics. They're looking at the data that's coming in that's telling them, hey, a storm is brewing.
Yeah. Yeah. Well, hey guys, this is not the seller's time to queue to overprice. It's time to be strategic, price under the curve, and drive interest in encouraging offers. So that's just my little tidbit for what's going on. I'm seeing a lot of people thinking, oh, seller's market, seller's market, seller's market. The way to price in this market is not by overpricing. It's underpricing, and let it work its way up. But
and to tell you about that too, just to kind of go over that, I mean, people think like a perfect example in some of the areas, because rate is in across the whole United States, and so we see a lot of markets, right? And all markets are not the same. And when people see that inventory is going up, they automatically assume, oh, it's a buyer's market, and that's just simply not the case.
No.
The inventory is going up. Yes, that is correct. But when you look historically, we're still historically low. And these sellers are not doing fire sales. They're not going like, oh my God, we got to sell. They're sitting on 3% rates. They're sitting on a cash cow of equity. They're like, hey, I'll throw a little line out there and see if I get a bite, but I'm not going to be doing a fire sale or lowering it. And I'm seeing this day in, day out. So many buyers are telling their agents, hey, go for the jugular, offer 30,000, 40,000, 50,000 under, ask for 20, 30,000 closing costs, get that solar paid off as well. And then the seller's coming back going, no, thank you.
That's not happening.
Yeah, it's not happening. And they're like, wait a minute. I thought it was a buyer's market. And they're like, no, sorry. The armchair economists that are telling you that on social media don't understand the market. Yes, there's inventory, but they're not motivated to sell unless it makes sense to them. And, and that's where everyone's at in the market right now.
Well, the big thing that you need to point out there as well is, the inventory seems up comparatively to last month or the month before, but to 2019, 2020, we're still down a ton. So we're not doing apples to apples. We're doing apples to bananas. It's not even in the same. So that's the important thing. We might be seeing a little rise in new listings that are happening out there, but it's not anywhere near switching it to a buyer's market. But anyway, hey, the other weird thing that I wanted to talk about that's a little off our script here that's really changing the environment too, that is all this stuff that's going on over in Iran. I mean, that's having an impact on our rates. And, we got a lot of turmoil overseas that normally has a big bump to the positive in interest rates. But again, we have all these weird headwinds against us right now. So it's interesting. I want to get your take a little on that, Anthony. Like, I would have expected to see a little, bigger downturn in interest rates, meaning going down, getting a more positive rate for folks today. But it's just not happening between, the Fed's not moving the overnight rate, between this stuff happening. A lot of weird headwinds out there. Very odd. Tell me what your thought is on any of that.
I mean, you touched on this the last segment on how there's a lot of levers in the economy, and it's not just a one size fits all or one lever fits all. We talked about how the reason why we saw rates so low the past couple of years was because of the quantitative easing or the purchasing of mortgage-backed securities. Whereas now we are doing no quantitative easing. the Feds have been doing quantitative tightening, QT, and now they're laying off on that. But that's just one aspect. There are so many other parts that the economy relies on to see how, the engine's running. And to be honest with you, there's some things that are being changed that I've read over the weekend on how I believe this administration is now switching from, if the government is not going to introduce QE or quantitative easing, which isn't easy to understand for you viewers out there, that's the government purchasing mortgage-backed securities, MBS. So what I'm seeing now is, which is kind of brilliant if it works, is the administration now is saying, well, if our own government's not going to purchase them, we're going to reach out to the market on a global scale and educate and introduce outside influence to purchase mortgage-backed securities. Yeah. So places like India, places like who have Ireland, Britain, UK, looking for them to start purchasing and investing in our market in the form of purchasing mortgage-backed securities. So what does that do? That creates our GDP to go up. It also creates our mortgage-backed securities to go up and our yield to go down, to where it forces the rate down. Yep. I mean, if we see a 0.5% reduction in the rate, that's $300 billion that's going to be coming in to our GDP. If we do 1%, that's $600 billion. Now, do we want that to come from our own coffers in the form of the banks doing IOUs and getting those mortgage-backed securities? Or do we get it from outside our walls and bring it, and it truly being organically injecting into our economy? It's a win-win scenario. We get best of both worlds. We
balance that.
Yeah. But that, and so the caveat to that is this: there's so many things going on with the trade war and the tariffs, with the manufacturing, with the import and export. And now we have to deal with Iran and Israel. And all of this points to uncertainty. A lot of people think that, old school back in the days, war equals surplus and it creates jobs. And that's true. But what it also creates is fear and uncertainty. And the market does not like fear and uncertainty. And if there's fear and uncertainty in the future, how do they position themselves? In a defensive position. How do they price themselves? In a defensive position. Yeah. So it counteracts everything we're trying to do to lower these rates. You introduce uncertainty, you're introducing fear, and you're introducing a defensive position. And I think that's why we're seeing these rates stay higher for longer. It's because of all this fear and uncertainty.
The Feds are saying what I was saying a couple of weeks back in one of our shows: hold, just like my friend Mel in Braveheart with his blue painted face screaming, hold. But here we go. I got us a little off topic there. I apologize, but it's a big scene out there in the world that normally has a different effect on what's going on. So I thought it was worth interjecting just a little commentary. So I appreciate that, Anthony, and thanks for letting me do that. But I'm going to jump into our next one. Hey, the Fed rate pause means one thing. They're watching inflation like a hawk. So should you hit the pause too? Let's break it down. The Federal Reserve held steady again. We've talked about that. No surprise. We all kind of thought that was, but also no clue of what cuts might come. We believe that there's going to be a 0.5 point before year end, but when? And so I'm going to jump in and let Anthony give a little 2 cents on that as well.
Yeah, I mean, the silence, it's meaningful and it's strategic. The Fed's watching everything that we're watching. They're looking at the inflation. They're looking at the jobs. They're looking at the metrics. And listen, if these are still staying hot like we're seeing, the rate cuts are off the table. They're not going to cut the rates. I was just telling another agent the other day, and they're like, if the jobs are booming and inflation is in check and in line, why aren't they cutting the rates? It doesn't make sense. And I was like, well, that's the exact reason why they're not cutting the rates. The Feds don't just cut the rates because they feel like it. They do it as a necessity to ensure that it's not a crash landing. If they see the economy stalling, how do they back that up and inject, consensus into it? By making it cheaper and more affordable to borrow money. And if people are borrowing money like they're Prince at a Purple Rain concert, like it's 1999, then the feds are going to just stay on the sidelines and go, okay, all right, Americans, keep spending. And so it's kind of like if American people are, if they truly were mad about the rates, then they would show in their spending habits. They would completely shut the door on spending with homes, completely shut the door.
Eating the gummy worms. Stop eating the
You
gummy
would not
worms.
see credit card balances go up, cars being purchased, installment loans happening, people eating, churros at Disneyland. People are spending like there's no problem. So as long as that happens, the feds are going to say, all right, keep doing it. But as we talked about, there are some signs that confidence is going away.
Well, so what does this mean for the mortgage borrowers? Rates are still hovering. They're kind of bumped down a little bit. They're not rising at all, and they're not dropping either of any significance. We're still in this holding pattern. I think we're going to be there a little bit longer. But, Anthony, I don't think people should wait to buy. Right? We've always talked about that. Bring me in again, brother.
Yeah, I mean, the market is, just imagine, this is a perfect analogy. For me, I'm visual. I have to visualize stuff in order for it to make sense. I'm not as smart as cats like you, where you could just write it on paper and like Neo in the Matrix, the codes come down and you're like, for me, like you need to draw the horse and the little flower and the sun. So just imagine this. The market is like a car, okay? And the car is going. Now, if you just walk right to the car, you're just getting smacked in the head because the market is moving, the car is moving. And so you need a running start in order to get on that market. And the same goes with, should I buy or should I wait? If you wait, you're going to get smacked in the head with the market because it's going to run you over. You're not going to wake up and go, okay, the rates are low and money's flowing in the bank and there's no uncertainty and I'm ready. And, my name is, what's the guy's name? Oh God, the guy who wants no debt. What's his name?
Oh, no, I know who you're talking about. Not
Ramsey.
Yeah.
Thank you, Dave Ramsey.
Yeah.
If you were Dave Ramsey's kids, Dave will probably kill me if he hears this, but he's looking for everything to be perfect, and life is not perfect. Not everyone can wake up and have no debt. Not everyone can wake up and have no unknowing in the future. You have to be calculated uncomfortable. You have to get comfortable with being uncomfortable in a calculated way. And so I would say if you're looking to buy within the next 5 years, these next 6 to 12 months are going to be the most economical because you're not waiting for the herd to come. And then, everything comes in seasons. Everything comes in frequency, our heartbeat, radio waves, the same with market. And if you are trying to time the market, you'll never time it right because there's so many different parallels. So the only thing you need to time is you. Do you need a house? Do you need a dwelling? Do you need that extra space? Are you tired of renting? Are you tired of a landlord telling you what to do? Do you want a great generational wealth? Or do you just want to walk away with the security deposit after 5 years with nothing to show for it? No paid down principal, no earned equity, no tax incentives. So the right time is when you're ready, not when the market tells you you're ready. That's a fact.
Yeah. Educate. You got to be flexible. You got to understand what's going on, and you can't be afraid to chase your dreams. That's what we've already talked about over and over again. But this is using this period to prepare, get pre-qualified, understand your options, your numbers. Clarity comes from not perfect timing, but from being educated and being prepared when the right moment comes. So. All right.
Great.
Guess what time it is? It's rapid fire buzzwords with our buddy Kevin. He's going to bring some stuff in.
Oh, yeah.
Here we go, Kevin. I'll let you go here, buddy.
Yes. Rapid fire buzzwords. You know the drill. Limit your answers, please, to a sentence or two. They've been dragging on the last few weeks.
Hey, we got a lot to say in a short period of time to say it.
All right, let's get into it. Buzzword number 1, trade lines in dispute status. Let's take that one.
Anthony,
I'll
that's
take
all
it.
you, baby.
So trade lines are what's on your credit report. automobile, credit card, installment loans, student loans. Those are trade lines. And if you have disputes where maybe it's a derogatory status or a collection status or something that's not correct, if you dispute that account and it's an active dispute, you have to take it off. If the automated underwriting system asks for it, which 99% of the times it does. So in other words, if someone comes to me and they got a 620 FICO or 640 and they're good, but then the disputes are rampant and they're everywhere, if you take those disputes off, they could very well go down to 550 or 560 because those disputes are no longer active, masking on that credit report. So it's important to make sure the lender and you are looking at your credit report to understand if there's any disputes on there and to make sure it's not going to impede your approval.
Very good.
Excellent. All right, buzzword number 2, seller concessions.
So seller concessions is an amount that the seller is able to give towards the buyer in the form of a closing cost credit, and they can't exceed. Every one of our programs has a different amount that they can actually give a seller concession, but it is truly a seller credit and it has to be used for closing cost items, and they have to be something that is actually invoiced and it's dollar for dollar. So you can't just walk away with a check at closing. If the seller would give you a $15,000 closing cost credit or seller concession, same thing, and the closing costs only cost $7,000, you don't get to keep the extra money. So it's very important to work with your lender and understand what your actual costs are going to be, what the rules and limitations are for the product that you're using, and get the correct seller concession if you're going to get it.
Excellent. All right, number 3, rate buy down.
Oh, rate buy down. Something we're seeing a lot in this market. Using concessions or your own money to buy down the rate. It's important to make sure that you're not buying down the rate in a way that's uneconomical, meaning how much is it costing you to buy the rate down and how much you're saving. If you buy the rate down and it takes you 7 years to break even, and we know we're going to refinance very highly within the next 36 months, you're probably leaving money on the table. So you want to make sure you talk to your lender about temporary rate buy downs where there is no break even, compared to if you try to buy that rate down for the full 30 years, and then that break-even period extends even further.
So that temporary buy down is the special one, right, Anthony? That's the one where we can do an intermittent temporary buy down, so we can wait for these refinance rates that we feel are coming in the future sometime in the next 12 to 18 months. And so you can do that temporary buy down of your interest rate, and the money that you spend to do that, what you don't spend or the time period that you don't utilize it, you get those funds back, correct?
That's right. There's no break even. So you either do the whole 2 years to where you utilize all those funds, or if you refinance in a year and you still got money left over, you can that gets applied to the principal reduction. So you either use it or you don't lose it. That's the beautiful part about the temporary buy down. And it just basically condenses, and you get a bigger bang for your buck if you're buying down, say, 2 percentage points the first year and 1 percentage points compared to a 0.25% for the full 30 years. It just makes sense, and it's calculated, showing that you're looking out not further than just 30 days, but 2-3 years.
Yeah. Great product.
All right, next one, contract contingencies.
So I think you're referring to the sales contract that on a purchase that the buyer and the seller sign together, and there are contract contingencies in there that talk about home inspection timeframes and what could be expected in the event that there are large, problems found during the home inspection, or the appraisal contingency. And there's a time frame included in that says, hey, you have to have the appraisal contingency, in 21 days, in 12 days, and in some time frame that's agreed upon. And then there's the big one, the financing contingency. And all these are contractual obligations in the purchase contract that hold the buyer and the seller accountable for a time frame, so nobody can sit around willy-nilly and just let things happen. But they also give definition to what's going to occur in the event that we don't meet the actual contingency, and what would put you in a position that you would be able to walk away from the contract if you can't meet the contingency.
Yeah, there's like 3 main contingencies in all the, most of the United States that I've seen, which is you have the appraisal contingency in the event the appraisal comes in lower, the buyers can, buyers are protected and they can jet out from that escrow without any recourse. Or the loan contingency, typically it's broken down in the initial, or the CLA is what we call it, the conditional loan approval. And then we have the FLA, which is the final loan approval. So a lot of the territories that I lend in, we have the appraisal contingency, the initial conditional loan contingency, and the final loan contingency. So if they don't get, typically they give you a long runway, 2-3 weeks. And if you don't get that conditional, for some reason, something happens, the buyers are protected. Even to the point where we're waiting for final loan contingency. If something happens, the buyers are protected. So it's designed to make sure that the buyers know that even though they're putting big chunks of earnest deposit down, that if something were to happen unexpectedly or unforeseen, they're still protected contractually.
Awesome.
All right, next one, appraisal gap.
Yeah, I mean, we talked about this a couple of times, and we're going to see this a lot as we go into this market. We don't see it often on the shoulder months like we're seeing now, but as these rates go down and the demand goes up and the supply gets back to low, then we are going to see people offering highest and best, is what we call it in our world, where if you're a seller and you get 10 offers, your seller's agent is going to send out a reply to everyone going, there's a multiple offer situation. Give us your highest and best. Now, a lot of times that highest and best will supersede what that area purchase price is selling for. So if a house is for, say, $500,000, and in that area, it's about $500,000, but the offers now push it to $510,000, $515,000, $520,000, we're going to see an appraisal gap. We're going to see the way the market wants compared to where the appraisal is. And that's when the appraiser is going to go, okay, if you want this house, the highest one was sold was $500,000. You're going to have to pay that $20,000 appraisal gap out of pocket if you really want this. And that's what we saw a lot during COVID when the rates were in the 2s and 3s. They were the smartest people in the room. Monday morning quarterback, you can say, wow, like you were brilliant. I remember during those days, I had clients and some of them were like, well, I know rates aren't going to be like this forever. I don't mind spending 10, 15, 20,000 more of the appraisal gap because I know I'll make it up in the appreciation and in the savings of the interest. And I had other people going, I'm just going to wait. I'm just going to wait. And those guys blinked and were like, oh my God, rates are in the 6s, 7s, 8s.
Yeah.
What just happened?
That product that you're talking about, it's not a product. It's we over here in my neck, we call that an appraisal gap insurance, where the buyer will say, okay, I realize that there's possibly going to be a gap and I'm willing to put up, X amount of dollars, say $20,000 to cover the first $20,000 in shortfall. After that, we're going to renegotiate, Mr. Seller. So if it comes in at 30 light, I got the first 20, you're probably going to end up picking up the 10. And that gives the sellers a really good feel to say, hey, I know at least I'm getting this much when they're in a multi-bid highest and best offer scenario, that this person's given me the appraisal gap contingency or insurance, so that he's aware that if the appraisal comes in low, and it could, that he's covering X amount of dollars. That's one way that people are winning in this market over here by me.
Oh, that's interesting. That's good to know, because it's we're a lifetime away from each other, right?
Yeah.
You're in the middle of America, where I'm on an island. Even when we look at Florida or we look at California and in Hawaii, those places, I've never heard of that situation where there's an appraisal gap insurance going, hey, we're going to cover at least this amount. Typically in the areas that I'm at, it's like, hey, whatever the purchase price is that you're willing to put up, you're assuming that you're going to, pay that. Now, I will say the savvy sellers or the savvy seller agents, when there is a multiple highest and best offer, they'll also waive the appraisal contingency, because what that does is it forces the hand of the buyer to go, you waive the appraisal contingency. Therefore, if the appraisal comes in under, you must pay it. Now, you can't do this with FHA and VA because you have the amendatory clause, right? Where if the appraisal does come in lower, you can't force that buyer to purchase. Whereas conventional, all the rules are lost. And so a lot of times during the appraisal gap, era where there's highest and best offers, you will see them pick more conforming loans over FHA and VA because they know that amendatory clause is not applicable.
I'm working on a VA VA loan right now that's closing, I think, on Friday, that had the appraisal gap insurance. The appraisal came in $10,000 light, and actually $15,000 light. And one of my few that have come in light, buyer, put in his $10,000 appraisal gap insurance language that says, hey, I'm covering the first 10 on any shortfall. After that, we're talking. So, seller had to come down 5,000 on his purchase price, and buyer's coming up with an extra 10. VA loan, all's good. Everybody knew that there was going to be a situation like this. The pace of the market is quicker than what the appraisers can keep up with, meaning that the comps don't exist until this one closes. And now that's good for the next guy, but it's not good for this guy. And then this will keep hopscotching along until we get to that point where it levels off to some degree. So that's we got really long-winded there. Sorry, Kevin.
and I will say, let's look at the opposite. Let's look at the different. A lot of people think, well, this house is way undervalued. Am I going to see the appraisal come in 100,000 over? And that's a really good question. I tell my clients, I'm like, listen, the appraiser is not there to set the market based off of his assumption. He's there to set the market based off of what the demand is. And so if he sees there's an issue with the top end, he's going to circumvent that. But if it's the adverse and there's a house, unless it's glaringly obvious, like, oh my God, this is way under, it typically comes in at. Now, when appraisals come in over, you'll see them 10, 15,000 over. That is a nod from the appraiser going, there is an appraisal gap to the positive here. I don't want to subject my opinion in this and artificially raise the market, but this could have been sold for much higher. And they usually give a little nod, but they don't give the full story on the difference of the appraisal gap being higher.
They're bound to the actual comparables. That's the underlying story of all this. They have to use comparables so that it's not their opinion. They have actual data that's driving them to the final answer. So it comes down to, which I love to say, the math will set you free. The math is telling them what to do. They don't get to say, oh, I like this house so much better. They're looking at square footage, quality of construction and finishes, and putting that all into their breakdown, and that's where they come up with it. So that's the thing I feel bad for these appraisers. They get a bad rap sometimes. They don't have a lot of choices. This is driven
my
by...
My favorite is noise pollution. And so people are like, what are you talking about, noise pollution? And I'm like, well, think about it. If you got a house that, here's one house right here, here's another house. This house right here backs up against the back is a freeway. This house backs up against a park. Do you think they're going to be the same value? No, they're not. And a lot of people, so I have this all the time, are like, well, the house across the street sold for $10,000 more. Why? It's like, we got the I-1 freeway behind you compared, they have a green belt. That there's some money in that. And they're like, I never even thought of that.
Those birds are loud, though. Those birds are loud that are in the park. Oh, goodness. All right, Kevin, we'll give it back to you. So sorry.
All right. Next one, initial approval.
So that's the initial approval is when we go through our initial underwrite and we come up with a conditional loan commitment saying that everything looks great. There's these little things that need to be done and completed. Typically it's title work, or typically it's the appraisal that's still hanging out there because we don't have that in because our appraisers get to our files so quickly, or we need some clarification on a couple large deposits that we noticed in a bank statement. Also, we need your homeowner's insurance finalized. So that's an initial approval, or a conditional loan commitment is kind of interchangeable on that word.
Excellent. Next one, number 7, ARM loans.
So ARM loans, those are sponsored by Arm & Hammer. So, baking soda.
Is that how I can borrow Chris Hemsworth's arms?
That's it.
We're not getting into the have baking soda before you go to bed thing, are we? There's a lot of
Once-
that going on social right now.
A spoonful of baking soda makes the medicine go down. I think
No,
that's
I'm not talking about that, sunshine. You just move on.
no. Oh, so
Move on.
arm loans is variable, meaning, you know, could be a 3-year arm, 5-year arm, 7-year arm, 10-year arm. What do I mean by that? It means it's fixed for a certain duration of time and it will change a certain amount of times. Typically, like a 5-1 arm means it is fixed for 5 years, and then at which point it'll be changed at that 5-year mark or whatever the current market is. Now, arms are kind of like, you know, bad, you know, bad experiences, right? You think about arms and you think 2007 and you think predatory lending and you think, you know, oh my gosh, I wake up and I open my mail and I have a triple the payment. That is the case when you go from rates in the 2s to rates in the 6s and you triple your payment. But when you have rates in the 6s and you're only going to be going down, arms are people who are looking farther than just 12 months. They're looking farther runways. So my super savvy clients who really have a pulse on the economy and they see the writing on the walls and they can see they can save 0.25% on the rate or 0.5%, then they're going to go with that arm because they know that in 5 years, the probability of refinancing is very high because we have historically high rates. So arms are good only if it makes sense. Now, I will say the market will position itself in a defensive position is with pricing, making arms uneconomical because they don't want it. So just because arms are available doesn't mean that the banks want it because they're on the other side of the aisle and they don't want, you know, their portfolio all of a sudden going poof with these higher rates. So what do? They make rates lower, but they make the cost higher. Yeah. And so when you look at arms, you go, yeah, I can save 0.25%, but it's going to cost me 0.5% in points. They force you to stay in at a certain time. So they know that if you do decide to refinance, they've already made their money up front in those upfront points. So, you know, you have to time arms to make it make sense. And it's not just a one size fits all.
So let's just break it down. It means adjustable rate mortgage, correct, Anthony? And
adjustable rate mortgage is an ARM. That's the acronym.
That's the acronym. And then it's based off of short-term money, and that's why there's the volatility that we see right now because short-term money right now is not cheap. And so we're seeing a smaller gap than normal in an ARM product versus a long-term fixed product. So that's all I'll add to that.
And why do we see it not cheap? What does that tell us that the market's doing?
Being very defensive. I don't want this long-term money to sit on my books because it's costing me a fortune.
You see, so for our listeners out there, you've seen the correlations. You know, economics is a language. And once you start understanding it, then you start seeing correlations, you start seeing patterns. And there's a reason, you know, in the silence. There's methodology in the position that the banks and that the Feds and that the economy shows us. And we can learn a lot from it. And yeah, arms, you know, they show you what the market is thinking. And when you see pricing in a defensive position, that shows in the short term, they have no idea what the heck is going on. And they do not want any of that smoke. They're like, we do not subscribe to that smoke. We want none of it. If you want this, it's going to cost you.
Hey, my friend Kevin's giving me the red light because we're taking way too long on one of our questions again. Sorry, Kevin. He's got the blue light flashing over there. All right, next word, Kevin.
All right, let's close out this segment this week with closing costs.
All right, the closing costs I break down in 3 segments for the majority of my people to talk about what makes up the closing costs. And the first segment is what it costs to actually produce the loan for you. And so your lender costs, all the secondary costs that are that have invoices attached to them, like appraisals, credit reporting, the title work, the title closing fees. There's other things that are like tax certification fees. Those are all one lump sum. And then the next category is your prepaid items, and you have to have a year's worth of homeowners insurance put in place when you purchase a new home. So that's a prepaid item. And then you have your mortgage interest that takes you from the date of closing to the end of the month. And so that's also a prepaid item. So that's prepaid interest. And then the third category is your escrow holdbacks for property taxes and insurance. So those are the 3 segments that all are looked at as one whole as closing costs, but the true out-of-pocket expense to produce a loan is the first category, and that's what you should really understand. The rest of those things are equal across the board, lender to lender. So you want to look at the first ones and understand his invoiceable items, appraisal, title work, all that kind of stuff, and the lender fee itself are all, within market and not exorbitant. And that's how you really judge, am I working with the correct lender or am I working with somebody that's taking advantage of me? There you go.
Yeah, as a caveat to that, I would say the biggest misconception we get in our market is points in the closing costs. And people think that points go directly to us, and points do not go to us. We do not make money off of your points. We don't make money off of your rate. We don't make money off of your program. We make money off of the volume that we close in, and the bank pays us. So the two things you see in the closing costs are the origination or underwriting fee, or some people do both. And then you see the points. The points are a direct result in where you're locking your rate, meaning, are you locking your rate at market where it's par, no cost? Are you buying that rate down to see points where you're going to make up that cost in the form of a lower payment? So it's really important to understand when you look at your closing costs, you understand which bucket is and which bucket isn't. And that'll really give you an understanding if you're getting a good deal or not. But the big thing is, how much are they charging you for your underwriting? How much are they charging you for, the financing? And as long as, what the average is under $1,500, I know we're under $1,500 as far as, underwriting fees, which is the norm. Some credit unions, you'll see $1,100, $1,200. But yeah, I mean, that's the going rate nowadays.
Yep.
All right. Thank you. And if you are watching or listening and have a buzzword for us to break down in a future episode, leave us a comment, send us a message, and it might be featured on a future episode. Manley, what's next?
All right, here we go. Buyers are back in the game. Is it your time to step up before the next frenzy begins? I think so. Anthony.
I mean, we saw it was over 12% applications. It was the biggest jump this month, year to date. I think it was 12.5%. So buyers are now getting primed. They are now starting to see okay, what's the consensus? What's the trajectory here? And they're seeing that the talks are not about raising rates. They're about lowering rates. That is the mantra. And when you say that enough, people are going to start understanding that we're not talking about higher rates in the future. We're talking about lower rates. So I should probably get off the sidelines and start planning. And that's what we're seeing. I'm seeing a massive influx in applications of people going, I'm noticing the talk is only about lowering rates. I want to be ready. So that way, if a house does come up, I'm ready to go. I know my payment. I know my out of pocket. I know my purchase power. And I'm not because literally you'll see something happen that week. And then that weekend, people are just out there, burning and churning. It's all about, again, what the feds talk about essentially is the habit of the spending that the consumer does. And so now I think the cat's out of the bag, and the feds know that. They're like, okay, they know that we got to cut these rates. They know that it's coming, and we can't keep, telling them it's coming, and it's not. In fact, we're going to see 2 rate cuts this year. That's what the feds talked about last week. They did not do it for July, which we already knew. But the fact that we went from 1 to 2 rate cuts kind of shows the cards, so to speak, which is good.
Well, hey, inventory is starting to climb, which signals to many buyers it's a signal they were waiting for. And even a small increase like that is triggering this action. So people are getting off the fence post and taking advantage of this, in my opinion.
Yeah, I mean, it's a confidence shift, right? I mean, people are having a coming to their God, keeping it
Buddha
for everyone, whatever deity that if you're choosing, they're having a talk with them, and they're saying okay, so I guess rates are never going to be 2s and 3s again, and that carrot has been eaten, and that ship is not only sailed, but it's came back and sailed like 4 or 5 times. And people are now getting more confident with reality. Before, it was kind of like, no, I don't believe it. And then they were angry, and they're like, I can't believe it. And now they're coming to their senses going, okay, I see what's going on. And that's what we're seeing now.
This
The
ain't changing.
conversations I'm having with clients through the last 18 months was, I can't believe I can't believe I waited. I can't believe I didn't take advantage of it. And then the acceptance the last 12 months was, okay, lick our wounds. Let's see what happens. And I'm just going to wait. Whereas now that confidence is, all right, now is the time to buy. And with rates touching the fives, I don't want to make the mistake that I did last time and wait. And I'm going to take the advice of the professionals, and I can always refinance later. And that's the thing. You know that rates are historically high. And so if rates are historically high and you know they're only going to be going down the next 36 months based off of what the Feds who set the tone, then you know that there's an extremely high likelihood that your rate's going to be lower. So if they're confident, they're like, I can do a 6% rate, a 6.1% rate, knowing that I can refinance to the mid fives, lower fives. People are having those conversations right now at their table, and they're saying it's time to buy.
Hey, this window could close quickly though, right? Rates may bounce. Inventory could tighten. The key is to be ready, as we've been talking about all along. Educate, be ready, be prepared.
Yeah, it's know your market, right? Know your market, know your target. And so just like with any journey, if you don't have MapQuest, that's like back in the day, or what is it? What's that? What do we used to use? Garmin? You remember the big TV screen Garmin with the triple suction cup that you had to, you had to lick the suction cups and stick it on there. And then you had this
I used the big book that I had on my car seat next to me that I had it all highlighted and tagged up to jump me from page to page. That's what I used.
See, you're showing your age now, Manly. For me,
I'm good at that. I'm not a youngster like you are.
I graduated high school in 2001. I mean, basically, I remember one quick thing is I was in San Diego and my Garmin was malfunctioning, and it was, it still didn't have color. It was like black and white. And I was on my way and I was like wanting to stop off at La Jolla, and I didn't realize that my Garmin was stuck. And then I passed into Mexico. I passed into Tijuana, and I was like, why is everything in Spanish? And,
and that's a story you told your wife. I love it.
I did. No, I was like, I'm in Mexico. I need to get back. And it's all because of Garmin. But no, I mean, no, it's know your market, and it's know your, you know your market, you know where you're going, you know your target. You're going to make better decisions. And like we talked about, we want to make sure we're making decisions off of sound information, not out of fear or the absence of information. And so ask yourself, for your listeners out there, am I buying a house off of fear? Am I not buying a house off of fear? And if you are, I pressure you to get confident and get knowledge, get educated, so that way you're making decisions, or you're not making decisions off of sound information and not out of fear.
Hey, in other news, investors are retreating, and that's creating rare breathing room for everyday buyers. Investor activity is actually down sharply in 2025. In some markets, purchases are down over 60%. That's a major shift, and leaving opportunity for your everyday buyers, your primary residence buyers, to take up opportunity that they didn't have.
Yeah, I mean, we saw a shift from a digital, digital position to a physical position with a lot of our investors, whether they're taking crypto or Bitcoin or stocks or bonds, and then they're converting it going, I want to put this in a better shelter that's recession proof. What's better? A physical asset. And so we saw a lot of that over the past 12 to 18 months of people positioning themselves out of a digital and putting them into a physical. And so what does that do for our normal buyers? It crowds the market, right? How many times were we, putting offers out for our clients and we are getting beat out by cash buyers? It was like gangbusters, literally every single time. I would have people put 6, 7 offers out, and all of them would be beaten out by cash, because cash would just come in and swoop it up and make a super quick close, super easy. We are now seeing a shift from that, and people are not doing that any longer. One, the positions are changed. Two, the cost to finance is more. So when people are looking at bottom lines, they got to put more cash in for their cash flow to make sense. Before, when the rates were in the threes, you can put 15%. I was doing in the 2s and 3s, and I'm sure you were doing the same, I was doing 15% down investments. And they didn't care if the rates were higher because the rates were like at 5%, but they could put 15% down, less upfront cost. So their debt position was bigger, but their rate of return was much bigger, and they were able to get it for much less. Whereas now, most investors, for it to make sense, a minimum of 25%. Now you would think, why not 20%? It's because 20%, yes, to the banks, you don't need any mortgage insurance. But the gray area is the 20% because you don't need mortgage insurance, but you're really close to needing it. Once you hit that 25%, you no longer are in that gray area, and that gives less risk. Therefore, you get incentivized with a lower rate. So that's why I always tell my clients, if you're looking for the best rate, your area is 15% down or 25% down. 20% down, yes, you have no mortgage insurance, but you'll see a higher rate. And then when they look at, people with my 800 FICO score, and they're like, I can only put 10% down and I can save 30 grand and I only pay $60 in mortgage insurance. I'm like, yeah, that's it. So, right now we're seeing a lot of investors shift, and they're kind of saying this doesn't make sense right now, so I'm going to be on the sidelines. What does that help for our clients? Right now, it creates inventory to go up, and it creates options for our buyers to not have to settle. And remember, this doesn't last forever. Just like all markets, they go up and down. There's going to come a time when these rates hit the 5s and the investors start putting on the gas, and that's going to create inventory shortages.
Are you telling me the investor race is over? I think this healthier market we're in, it's not perfect, but fair. So
I would say that they're at a pit stop right now. Those investor cars are at a pit stop, and they're just kind of seeing how the market plays out. Because again, investors want to see runway. And if there's clouds, they don't want to land. And so the longer runway they have, the more prone they are to transact, because most of the time they're looking at short term, 3 to 5 years. How can I make money off this? How can I flip it? They're not looking at long term like families where, hey, how can I make an investment that's sound for my family? Not only short term, but long term. So right now it's the cars are on the sidelines at a pit stop. Don't wait for them to get out and get back onto the racetrack.
Yep. You're right. So, hey, 2025, 2026 could be wild, but those who plan today will win tomorrow. Don't just watch this market, get ready to play in it. As we wrap up, let's talk about what lies ahead over the next 12 to 24 months. We expect more clarity, but not necessarily calm. The economy will keep evolving. The Fed will eventually make a move, and mortgage rates could shift fast, up or down.
Yeah, I would say the big mantra is planning. Plan, plan, plan. Do not wait and sit. You can wait, but plan. Ask the questions, and this is for not just people who are looking to buy homes, but people who currently own homes. And maybe you're making to make a switch, but you don't know if it'll make sense. Make sure you plan. Talk to someone like myself and you, Manley, to say, what does this look like? What's the picture look like? Take these question marks off the plate, so that way they have nothing but resources to go, okay, here's my options. A, B, C, D, E. This is what it looks like on paper. This is what I can do. And you'll be surprised of how better it looks, because, we're our worst enemy. We're going to create obstacles for ourselves that are really not reality. And it's just to be in the defensive position. Whereas once you talk to someone like ourselves and a mortgage professional who looks at the whole situation, we can start giving you numbers, math. We can start giving you facts, so that way you can start making these decisions off of clear advice and not out of fear. So plan, regardless if you're waiting on the sidelines or you're actively searching.
The buyers who win in this next market cycle won't be the ones who waited. They'll be the ones who were prepared, who understood their numbers and got pre-approved and stayed engaged with their lender.
I agree. Planning now, plan for tomorrow. You do not just shoot by the hip. When you go into a gunfight, you're looking at your adversary and you're going, does this person want to be my huckleberry? Say when, and, you have to plan. If you don't plan and you just shoot by the hip, Doc Holliday is definitely going to live another day.
He's your man. Hey guys, thanks again for listening to the Mortgage 101 podcast or watching us. I hope you're watching us on YouTube. And until next time, stay informed, stay prepared, stay in the game.
Mahalo.
If this episode helped you feel more confident about your home buying journey, do us a favor. Share it with a friend, subscribe, leave a review, and if you've got a question or a topic you want us to cover, hit us up with a DM or a comment. Thanks for listening to the Mortgage 101 podcast. We'll see you next time.